In the previous video on the psychology of winning trades, we talked about what goes through a trader's head when he's riding a position that works in his favor. That's important. But today, I want to talk to you about the opposite side of the hill, the part most traders don't like to look at. What every trader misses at the end of a bull run, and believe me, I've seen more than a few of them. A bull market is the easiest thing in the world to make money in. You buy stocks, you hold them, and prices keep climbing. You feel smart, the newspapers confirm it, your friends envy you, and your broker tells you what a natural trader you are. But let me ask you something: when everyone around you is making money, when your cab driver is giving you tips, when the clerks at the store are talking about the market, who do you think is left to buy? That's the question nobody wants to ask. It's the question you forget when the ticker keeps printing higher and higher prices and you feel like the game can't end. But it always ends. Always. You see, the end of a bull market doesn't announce itself. There are no bells ringing, no headlines that tell you this is the top. The signs are there, though, but you've got to look past the noise, past the excitement. Most traders don't. They're too busy celebrating profits that aren't profits until they're taken. Tell me, how many times have you seen a man ride a stock up, watch it double, triple, then lose half the gains because he wouldn't sell? That's the first thing every trader misses at the end of a bull run, the difference between paper profits and real profits. Numbers on a page don't mean a thing until you've turned them into cash. I've watched fortunes disappear because the man holding them thought he was too clever to take his winnings off the table. Now, here's something most people don't realize. In a rising market, you don't need to be skilled. You only need to have the courage to buy and sit. The market does the work for you. But when the top comes, and it always comes, that same courage becomes your worst enemy. Because you think sitting tight will save you, when in reality it buries you. Do you see the trap? You've been trained by the bull to do one thing: buy and hold. And the bull rewards you for it, again and again, until the lesson is drilled into your bones. Then the game changes, and what worked yesterday destroys you today. That's the cruel thing about trading. The market teaches you bad habits in good times, and when the tide turns, you're left holding on to habits that no longer work. Think about it. How many times have you told yourself, this is just a correction? Prices will bounce back. I'll sell when it recovers. And how many times did that recovery never come? The crowd always waits for the bounce that marks the end of the game. But more often than not, the bounce never reaches the old high. That's how the market works. It leaves the greatest number of people with hope right before it takes everything from them. Another thing every trader misses at the end of a bull run is volume. People love to look at prices. But what good are prices if you don't know how many shares are changing hands? At the end of a bull run, you'll see wild fluctuations up one day, down the next. You'll see heavy volume at the top, as the smart money unloads to the latecomers. Do you pay attention to that? Or do you only care that the stock is still climbing? I'll tell you something from my own experience. The ticker tape never lies. It doesn't care about what you think, or what your friends think, or what the newspapers say. All it does is print the truth. But most traders are blind to it. They're too busy wanting the market to do what they hope. And that's the worst disease a trader can have: hope. Now let me ask you, do you trade on hope, or do you trade on facts? At the end of a bull run, hope is everywhere. It's intoxicating. The man who bought late is praying for one more rally so he can get out even. The man who bought early is greedy, waiting for one more surge to make a fortune. Both are blind. Both refuse to see the signals right in front of them. What signals am I talking about? For one, when the market stops reacting to good news. In a healthy bull market, every piece of positive news sends prices soaring. But at the end, you'll notice something different. The news is still good, sometimes better than ever, but the stocks barely move. Or worse, they go down. That's when you know the run is over. When the best possible news can't lift the market anymore, that's the end of the story. And yet, most traders ignore this. Why? Because they don't want the story to end. They've built castles in the air, planned their riches, and they don't want reality knocking on the door. But the market doesn't care what you want. It does what it does. Remember in that last video when we spoke about the mindset that makes you hold on to winners? That psychology is the very same thing that betrays you at the end of a bull run. Because what felt like discipline yesterday turns into stubbornness today. The very trait that made you money before now costs you money. That's the shift most traders miss. Let me put it plainly, no one ever went broke taking profits, but plenty went broke refusing to. At the top of a bull market, you've got to ask yourself, am I here to be right, or am I here to make money? Because if you're in this game to be right, you'll hold on until the market proves you wrong, and by then, it'll be too late. I've learned that the top doesn't look dangerous when you're standing on it. It feels like the safest place in the world. Everyone's agreeing with you. The profits are rolling in, the air is thin but exhilarating. But just one misstep, and you tumble down faster than you climbed. And when the fall starts, it happens quicker than you can believe. Tell me, do you think you'll be fast enough to get out once the slide begins? Most traders aren't. They hesitate. They tell themselves they'll sell tomorrow, and tomorrow turns into the day after. Before they know it, they've lost a year's worth of gains in a week. That's how the market works. It takes the stairs up and the elevator down. Another thing that fools traders is the memory of the bull. You get conditioned to expect new highs. Every dip has been a buying opportunity, so you keep telling yourself this dip will be the same. But markets don't repeat forever. They change character, and if you can't recognize the change, you'll pay dearly. The big money isn't made in the middle of the move. It's made at the beginning and the end. The beginning when nobody believes. And the end when everybody believes too much. If you can't recognize those turning points, you'll always be late to the party. So ask yourself when you see the whole world buying, are you brave enough to sell? You see, that's the irony. It takes courage to buy when everyone else is afraid. But it takes twice as much courage to sell when everyone else is euphoric. And that's why so few people get out at the top. They don't want to feel foolish walking away while prices are still climbing. But you know what's worse than feeling foolish? Watching your profits vanish because you were too proud to act. The end of a bull market is where the crowd learns the hardest lesson. Wealth isn't built by riding every last inch of a trend. It's built by protecting what you've made and living to trade another day. Think of it like this. The market is a series of campaigns. Your goal isn't to win every battle, it's to survive long enough to fight the next one. But most traders don't see it that way. They treat each move like it's their only chance. They get greedy, overstay their welcome, and then blame the market when they lose. But the truth is, the market gave them plenty of warnings. They just chose not to listen. Now, let me ask you, are you the kind of trader who listens? Or are you the kind who waits until the market teaches you the hard way? Because believe me, the market has no problem teaching you lessons. And the tuition is always expensive. The crowd is always late. That's a truth in markets as old as speculation itself, and yet it's the one lesson people never seem to learn. At the end of a bull run, you can see it in plain sight if you know where to look. The professionals, the ones who've been in this game long enough to know the rhythm of the tape, they're already moving out quietly. They've bought when nobody else wanted to, they've sat through the rise, and now they're unloading to the very people who swore they'd never touch stocks until they saw them climbing. Doesn't that sound familiar to you? Think back to any great run you've seen, whether in stocks, commodities, or currencies. In the beginning, nobody cares. The papers ignore it, the public dismisses it, the average man thinks it's a waste of time. The price starts climbing quietly, almost unnoticed. Who's buying then? Not the crowd. The operators, the old hands, the few who know that big moves start when the market is asleep. They accumulate slowly, patiently, taking what they can without disturbing the price too much. Then the move matures. The headlines start catching on. You begin to see it in the financial pages. Analysts start raising their targets, and suddenly the stock isn't such a bad idea anymore. That's when the first wave of the crowd comes in, still early enough to make money, but already late compared to the smart money that positioned months ago. The stock keeps climbing, the bull market broadens, and more people take notice. By the time you get to the later stages of the bull run, the thing has turned into a parade. Everybody is in on it. The young clerks who've never placed a trade in their lives, the taxi drivers, the barbers, even the men who once called speculation a fool's game. They're suddenly full of advice. Have you ever wondered why? It's because the crowd only believes in the move after the evidence has become undeniable. They need proof before they act. They need to see prices already doubled before they dare to put up $1. But here's the trick. By the time the crowd believes, the game is already in its final innings. When your neighbor, who's never bought a share in his life, tells you it's time to get into the market, ask yourself who's left to buy after him, who will push the prices higher once even the most reluctant man has finally stepped in. That's the point most traders miss. The latecomers don't realize they're the last link in the chain. They think they're joining a winning parade, when in reality, they're marching into the slaughterhouse. It's always the same story. At the peak, the demand from new entrants dries up. There are no fresh buyers, just the public recycling the same hopes among themselves. Meanwhile, the smart operators are distributing, selling their positions, handing off the stock piece by piece to the eager newcomers. And you know what? The crowd thinks it's a gift. They think they're lucky to be finally getting in. They don't realize they're catching what somebody else is dumping. Let me ask you this: how many times have you bought late, convinced the trend would last forever, only to watch it turn against you right after you got in? How many times did you think you were being clever, when in fact you were just being part of the herd arriving too late? Every trader has done it. The difference is whether you learn from it, or keep repeating it until you go broke. There's a rhythm to these things. In the early days of a bull market, it's accumulation. Quiet, unnoticed, deliberate. Then comes the markup, when the stock begins to move steadily higher and draws attention. Finally, the distribution, when the same hands that bought at the bottom are unloading at the top. The crowd only sees the markup phase. They ignore the other two. They don't even know they exist. But the men who make fortunes, they live by that rhythm. They know when to buy, they know when to sit, and most importantly, they know when to sell. And here's the cruel irony: the crowd always feels safest when they are in the most danger. They don't buy at the bottom when prices are cheap and pessimism is thick. They buy at the top when the talk is cheerful, when stocks have been running for months, when everybody else is doing the same thing. Safety in numbers, they call it. But in speculation, there is no safety in numbers. The majority is almost always wrong at the crucial turning points. Think about the psychology of it. The average man hates uncertainty. At the beginning of a bull move, everything looks uncertain. Nobody knows if the stock will really go anywhere. That uncertainty keeps him out. But once the move has proven itself, beyond doubt, that's when he decides it's safe. He needs confirmation, and by the time he gets it, the opportunity is already gone. That's why the crowd is always late. They need proof that eliminates the risk. But in eliminating the risk, they eliminate the profit too. The sad part is they don't even realize they're late. They think they're finally smart, finally catching on. They look at the line going up and convince themselves it'll keep going. And why wouldn't they? Every past dip has been bought. Every correction has been a chance to get in. They think the future will be the same. But markets don't repeat in straight lines. They cycle, they change character. The crowd never notices the change until it's too late. At the end of a bull run, watch the crowd. They'll start throwing caution to the wind. They'll use leverage they shouldn't. They'll put money into stocks they've never studied. They'll chase anything that's moving. It's the fever of the top, and the more they do it, the more they convince themselves this time is different. But it's never different. It only looks that way because they arrived late and mistake the ending for the beginning. And here's another thing: the crowd doesn't sell when it should. Even after the top, even when prices begin to roll over, they keep holding. Why? Because they arrived late. They can't afford to sell quickly. They're barely breaking even or just starting to taste profits. They need the rally to continue, so they convince themselves it's just a correction. That hope chains them to the stock, while the professionals have already moved on. By the time the crowd finally admits it's over, they're selling into weakness, handing back their gains, or, worse, selling at a loss. Do you see the trap now? The crowd is late coming in and late going out. They buy after the best part of the move has passed, and they sell after the worst of the decline has already happened. They live at the edges, always one step behind, never in front. That's why they never make serious money. They're reacting, not anticipating. And in trading, if you're reacting, you're already too late. So, the lesson is clear, though most don't learn it. If you follow the crowd, you'll arrive late, you'll pay the highest prices, and you'll sell at the lowest. If you want to succeed, you must think differently. You must be willing to buy when the crowd is afraid, and you must be willing to sell when the crowd is excited. That's the only way. Because the crowd, without fail, is always late. Wealth is preserved by protecting profits. That's a truth most traders only understand after they've lost more than they ever imagined they could. At the end of a bull run, it's easy to believe you're richer than you really are. You look at your account, you see the numbers climbing, and you start to think of it as yours. You start planning what you'll do with the money, how you'll spend it, how life will look different now that you've made it. But tell me, until you've sold, until you've taken those profits out of the market, are they really yours? Or are they just numbers on a screen, subject to the next swing of the tape? That's where most traders fail. They confuse paper profits with actual wealth. They let greed whisper in their ear that the move isn't done, that they can squeeze one more rally out of the market. They ride it, and for a while, it feels good. But sooner or later the market turns, as it always does, and what looked like a fortune evaporates faster than it came. Protecting profits isn't about being cautious, it's about being a realist. You can't build lasting wealth if you treat gains like they'll never disappear. I've watched men make a fortune in a single campaign, only to throw it away because they couldn't bring themselves to take money off the table. They believed the market owed them more. They believed the trend would never stop. But the market owes you nothing. It gives and it takes on its own terms. That's why protecting profits must be the first rule of wealth building for any trader. Ask yourself, are you in this game to look smart, or are you in it to walk away with money in your pocket? When I talk about protecting profits, I don't mean selling everything the moment you're ahead. That's not trading, that's fear. What I mean is learning how to recognize when the move has matured, when the risk of staying outweighs the reward of holding. At the end of a bull run, the danger isn't that you won't make money. The danger is that you won't keep it. You might ride the last surge, but if you don't step off in time, the fall will wipe away months, maybe years of gains. Tell me, is that worth it? Wealth isn't built in a single trade. It's built over a lifetime of trades, campaigns, cycles. That means survival matters more than glory. A trader who keeps his profits and comes back to fight another day will outlast the man who bets everything on catching the last uptick. And yet, most traders do the opposite. They risk too much at the very moment they should be protecting what they've already earned. It's human nature. The more you win, the more invincible you feel, and that feeling blinds you to the fact that the higher you climb, the sharper the fall. Think of it this way. If you doubled your account during a bull run, and then gave half of it back because you refused to sell, have you really made progress? Or have you just run in place while exhausting yourself? Too many traders confuse activity with achievement. They think because they're busy watching the tape, talking about positions, bragging about gains, that they're building wealth. But wealth is measured by what you keep, not what you almost had. The professionals, the ones who last, they always have one eye on defense. They know that offense wins you trades, but defense keeps you in the game. That's why they scale out of positions, why they trail stops, why they watch the character of the market change and adjust accordingly. They're not afraid to take money off the table when everyone else is still cheering. They'd rather walk away with enough than risk it all for too much. I've seen amateurs hold on to stocks at the top, telling themselves they'll sell after just one more rally. They're always waiting for one more. But one more never comes, or if it does, it comes too late to matter. And while they wait, their profits shrink. They don't realize that wealth isn't about milking the last penny from the trend. It's about securing enough so that the money works for you beyond the market. Think about the men who got rich in speculation and stayed rich. They didn't do it by swinging for the fences every time. They did it by stepping aside when the game was against them, by pocketing profits when the crowd was still greedy, and by never letting a winning campaign turn into a losing one. It's easy to buy, it's hard to sell. But the sale is what puts food on your table. The sale is what turns speculation into wealth. And here's something most traders never grasp: wealth built in the market is fragile if you treat it like a temporary windfall. If you don't protect your profits, you'll never compound them. And compounding is the only way fortunes are built. Making one good trade doesn't make you rich. Stringing together years of good trades, each protected and preserved, that's how real wealth is created. But if you give back half of every run because you're too greedy to sell, you'll always be starting over. Now ask yourself, why do most traders refuse to protect profits? Pride, plain and simple. They don't want to admit the move is over. They don't want to be the man who sold too early while prices kept climbing. But isn't it better to be the man who sold too early and kept his money than the man who sold too late and lost it all? Too many people care about looking clever. They'd rather brag about calling the top than quietly keeping their winnings. But quiet wealth is the only wealth that lasts. At the end of a bull run, the pressure to stay in is enormous. The newspapers are screaming about new highs. Your friends are talking about how much they've made, and every fiber of your being tells you not to miss out. But that's exactly when protecting profits matters most, because when the turn comes, and it always comes, it will be swift and merciless. If you're not prepared, you'll watch your hard-earned gains vanish in days. Isn't that the cruelest feeling? To have been right, to have made the right trade, only to end up with nothing because you didn't protect it. This is why wealth building through trading is never just about catching the move. It's about discipline at the end of the move. The man who buys well but sells poorly is no better off than the man who never bought at all. Protecting profits means thinking beyond the excitement of the moment. It means asking yourself, what will this money do for me tomorrow if I take it today? That's how traders turn gains into something lasting, whether it's reinvesting in new opportunities, securing their lifestyle, or simply keeping their capital safe for the next campaign. The market doesn't care how much you once had. It only cares how much you keep. That's the standard every trader should measure himself by. You can boast about big winners all you like, but if you can't hold on to the profits, you're just a gambler chasing thrills. Real traders build. They protect, they survive, and the way they do that is by treating profits as something to be guarded with the same seriousness as capital. Because in the end, profits are capital, tomorrow's stake, tomorrow's weapon in the next campaign. Lose them, and you lose your chance to fight again. Hope replaces discipline. That's the silent disease that spreads fastest at the end of a bull run. In the beginning of a campaign, when the market is uncertain and the crowd is doubtful, discipline is what keeps a trader alive. You pick your entry carefully, you size your positions with caution, you watch your stops, and you treat every move with respect. But after months of rising prices, after watching trade after trade work out in your favor, that sharp edge of discipline begins to dull. You stop following your rules as closely. You tell yourself you can bend them just this once because the trend is so strong. And slowly, almost without noticing it, you start trading on hope instead of discipline. It doesn't happen overnight. It creeps in. At first, You're just letting your stop slide a little lower because you're sure the market will bounce back. Then you're holding on a little longer than you should because this stock always recovers. And before you know it, you're no longer managing risk, you're crossing your fingers. Doesn't that sound familiar? The reason hope takes over is because of the conditioning the bull market gives you. In a rising market, mistakes get forgiven. You buy late, and the stock still goes up. You ignore your stop, and the price comes back in your favor. You get sloppy with your timing, but the momentum bails you out. The market teaches you bad habits by rewarding them, and nothing is more dangerous than bad habits disguised as success. Because when the tide finally turns, those same habits destroy you. At the end of a bull run, hope becomes the main strategy of the crowd. Everyone is hoping for one more rally, one more bounce, one more chance to get out at the top. They hold their losers and say, "It'll come back." They hold their winners and say, "It's going even higher." And all the while, discipline, the thing that would actually save them, is abandoned. They know what they should do. They've read the books, they've heard the rules, but the intoxicating lure of hope drowns it all out. The worst part is that hope feels good. Discipline feels cold, mechanical, even harsh. Discipline tells you to sell when you'd rather hold. Discipline tells you to take a loss before it gets bigger. Discipline forces you to act while the crowd is still dreaming. Hope, on the other hand, soothes you. It tells you not to worry, that everything will be fine, that the market will fix your mistakes if you just wait long enough. Which voice do you think most traders listen to? Let me ask you this: have you ever sat there watching a stock fall against you, telling yourself, "I'll sell when it gets back to my entry price"? That's hope talking. That's not trading. That's gambling, waiting for the market to give you a miracle. A disciplined trader never says, "I'll get out when it comes back." He gets out when his rule tells him to, because he knows that by the time the market gives you what you're hoping for, if it ever does, you'll already have wasted time, energy, and capital you could have used elsewhere. Hope also clouds judgment on the upside. Traders get into the habit of thinking, "It's gone this high, it can go higher." They ignore signs of weakness, they ignore distribution, they ignore volume shifts. They tell themselves the stock is just consolidating before the next move. They convince themselves that what they want is what will happen. But wanting is not analysis. The market doesn't move because you want it to. And yet, at the end of every bull run, you'll see traders clinging to positions with nothing but hope in their corner. Discipline is unemotional. It doesn't care about your feelings or your wishes. It's a set of rules you follow no matter how uncomfortable it feels. That's why it's so hard to maintain when the crowd is euphoric. When everyone around you is telling stories of easy money, your discipline starts to feel like a burden. You look at your neighbor making a killing by holding, and you wonder if maybe your rules are holding you back. So you loosen them, just a little, and suddenly you're off the rails. Isn't it strange how quickly discipline can slip away when greed is in the air? And yet, the trader who survives is the one who guards his discipline like a treasure, because he knows that once hope sneaks in, it takes over everything. Hope makes you rationalize every bad decision. Hope convinces you the chart doesn't mean what it clearly shows. Hope blinds you to the signals that the run is over. That's why hope is more dangerous than fear. Fear at least wakes you up. Hope lulls you to sleep while the fire spreads around you. When the bull run is ending, you'll notice something in the tape. Prices stop responding the way they used to. The same strength that carried stocks higher starts to fade. Instead of rallying on good news, stocks hesitate, sometimes even fall. Instead of every dip being bought, some dips keep dipping. These are the signals discipline teaches you to watch for, but hope tells you to ignore them. Hope whispers, "This time is different. Just wait, it'll turn around." And that's how traders who knew better still get caught. The crowd has a phrase they repeat like a prayer: "The market always comes back." They cling to it whenever prices start falling. But that's not discipline, that's hope. And the truth is, the market doesn't always come back. Plenty of stocks never recover. Plenty of bull runs end in ways that leave no chance for the latecomers to escape whole. The ones who survive are the ones who don't rely on hope to save them. They rely on discipline to get them out before the damage is done. There's another angle to this too. Hope doesn't just cost you money, it costs you time. When you're stuck in a losing trade, hoping it comes back, your capital is tied up. You can't use it for better opportunities. You're sitting there, waiting, watching, wishing, while disciplined traders are freeing up their money and moving on to the next play. And in markets, time is as valuable as capital. Waste enough of it, and you'll miss the real moves that could have made you rich. That's why protecting discipline at the end of a bull run is so critical. It's the point in the cycle when hope is at its loudest. The crowd is drunk on profits, they believe the party will never end, and they're quick to laugh at anyone who talks about caution. But that's exactly when discipline matters most. Because when the turn comes, the crowd's hope will turn into panic, and the trader, who gave up his rules, will be swept away with them.